So, welcome to the first episode of my program where I interview traders and investors uh, who have a wealth of experience in their own fields and I believe will add great value to anyone who is watching this program. In this episode, I have with me Anando Ghosh, who is an ex-VP Citibank Global Markets and was trading from Hong Kong for several years. Currently, he is trading his own money and is based in Calcutta. So, welcome, Anando,
Thank you.
to my first episode. So, you are my first interviewee, so to speak. So,
Thank you. Thank you
it's
very much for having me.
a fantastic thing. So, generally, I wanted to chat with you about your own trading career from Citibank days to current days and how it has emerged and grown, evolved and grown. So, let me start right from the beginning. How did you
Right.
start your journey as a trader? I mean, when did it start? Was it circumstantial, or did you always want to be a trader? What was it?
Absolutely. I always wanted to be a trader. So this is something you may not know about me. I've never read the sports page of any newspaper. But even as a school kid, I used to be fascinated by the stock pages that used to come even in our general newspapers in those days, and I used to watch those numbers. So at the first opportunity when I had saved up enough money, because as Bengalis we get a lot of money during Dasheras from all the relatives, so I kept saving that. And when I had saved up enough money, so I think I was still a teenager when I bought my first stock for all the wrong reasons.
Oh, oh,
So what had happened is that Reliance Industries had done a split,
okay,
uh, and unfortunately, the paper was recording the stock price of the Reliance Industries post split, but it did not adjust the 52-week high low for the split.
okay,
So obviously, it appeared that Reliance Industries after the split was trading at its 52-week lows,
correct, correct, correct.
because the 52-week high is not adjusted, but in fact, it was actually trading at its 52-week highs. So I still remember the price. The 52-week high low was around 150, 300 approximately, and Reliance had split when it was at 300 rupees. So the price had come down to 150, and I said, "Wow, this looks good. This is a great company at its 52-week close. Let me buy it." So I bought it, and obviously the stock fell down promptly after that to 120. So I bought around 150, fell down to 120. What I did next was classic. I shut the newspaper and I didn't watch the stock price for the next 3 years. And what happened in the next 3 years is the stock went from 150 to 370.
Okay,
And that's the point. So my parents were never comfortable with me investing in the stock markets because they always thought it was a kind of a gambler's den. And the moment
absolutely.
anybody enters it, his career is in academics is completely over. So anyway, at 373, when now I'm in engineering college, and my mother just calls up and says that it's a 373, and why don't you do one thing? You cash out. I said, okay, fine, cash out. And so I remember cashing out. I think I invested 6,000 and I cashed out 20,000 rupees from that stock, from which my mother bought some jewelry. And it taught me all the wrong lessons. It taught me all the wrong lessons that you buy a stock and you hold it, and even if you forget about it, you're going to make a lot of money.
Correct.
And which is what I did for my next three investments. So now I have done my MBA and I have joined ICICI Securities, and my first job is that of a IT analyst in 2000. So you can imagine the excitement of being an IT analyst for somebody who knows nothing about stocks except for the fact that if you buy and hold, you will definitely make a lot of money. So I bought HCL Technologies, Hughes Software, and another company called Digital Equipment. So Hughes Software and Digital Equipment, they no longer exist. And promptly, and this I did in the, let's say in May of 2000. So you can imagine that my investments went down by 50%. So as usual, I shut the market, stopped looking at the stocks, and I just waited for the stocks to come back. So in 2003, when I was about to leave for Hong Kong, so I looked at the portfolio, and Hughes Software and Digital Equipment had done very well.
Hmm.
And HCL Technologies had gone down by 50% from my cost price. So all in all, in the portfolio, I was probably breaking even. So I sold the entire portfolio. I went to Hong Kong. And I figured out that this buy and hold is not a good strategy. And I got heavily into technical analysis. And through technical analysis, through luck, sheer luck, I came across a book called Trend Following by Michael Covel. And that's when I knew that I had found my calling insofar as how to buy or sell stocks are concerned. And that's when I got into trend following using very simple technical indicators on the price. And this is a skill that I honed for the next 10 years. And eventually I came back to Calcutta with the intention of trend follow on not just stocks but also commodities. This was in 2012, and I had a pretty good run up until let's say 2016, up until Brexit, because what had happened is I practiced trend following not just on stocks but also on all sorts of commodities, including agricultural commodities. So at its peak, I was trading like 30 different assets.
Wow.
I traded like dhania, traded haldi, traded chana, and I made a lot of money in those assets because the moment I started trading, we had the great monsoon of 2013. If you remember, 2013 was a great year
Correct.
for the monsoons, and I was short. So obviously, when there was monsoon, you're going to expect a surplus in all those crops. So all these agricultural commodities had a massive bear market.
Correct.
And I caught that through my trend following, and I was very happy until I realized that over the long term, commodities actually don't trend. And my trend following is a long term trend following strategy. So for me, the 100-day moving average is kind of a medium term average, or I would say a short term average. So as I tried trading commodities using that long term, that 100-day moving average, I, as you would expect, started losing money because of the whipsaws.
Correct.
And eventually I figured out that fine, trend following is fine, but actually, believe it or not, trend following works best on stocks. So what I did next was to actually try and figure out 10 to 20 stocks. So I first started with 20 stocks, uh, which are fundamentally very, very sound companies with a lot of runway for growth. And eventually now I have pruned that list to 10 stocks, and I practice trend following with the same long-term trend following system, and it has been working great because the stocks that I have in my portfolio or I have in this systematic trend following strategies are stocks like Bajaj Finance, Bandhan Bank. I have HDFC Life Insurance. These are the financials. Then I have Asian Paints. I have Aisha Motors and stocks like that. So essentially, these have to be in futures because I trade futures with leverage. So usually I have a leverage component of about 3x. So that is how I make my money. And one important thing that I learned very early on, even in 2012, is that stock selection is very important. The asset selection is very important because most assets in the entire world, they don't trade. Even currencies don't trend. So you have to, barring the US dollar, Japanese yen, they don't trend.
Correct.
So you have to be very careful in your asset selection, but mostly you make money on your sizing. It is uh, far more important to have the right size of Bajaj Finance rather than to figure out whether Bajaj Finance is the right stock or whether Bajaj FinServ is the right stock.
Correct.
So have good quality growth stocks, but more than having, because Bajaj FinServ or HDFC Bank, they're both equally good growth stocks. Some Bajaj Finance may grow at 25%, its share price and its EPS. HDFC Bank will probably grow at 17-18% for the next 10 years. What will make more money is a system that right sizes your position,
Correct.
be it HDFC Bank or Bajaj Finance. So this is what my trading journey has been. But eventually, what happened is I also started building a investment book. And why is that? So initially, I used to put cash as my margins for the futures trading.
Okay.
And I realized cash gets me no return.
Hmm.
And over the long term, index fund like Nifty Beast will eventually get me 10-12% returns. So instead of investing in cash, what I started doing is I started buying Nifty Beast, not with a mindset of making money out of it, but simply to post as margins.
Okay.
So now what I have done is I have posted my margins in Nifty Bees, and that became my investment book, and that is how I have an investment book entirely in Nifty Bees, which I
Okay.
leverage for margins, and then I have this systematic trend following.
Great. So you have explained a lot of things. So I wanted to reiterate or ask a few questions to, which could reinforce whatever I've heard. So the first thing is that your educational background in management,
Yeah,
it helped you open doors, to get into Hong Kong, correct?
right, right.
And did that educational background actually help in your trading itself, or was trading a separate thing? It was just educational background just open doors.
Absolutely. The only thing that the educational background did was open the doors. That's
Okay.
it.
Okay.
It did not help me even an iota. Maybe it's a personal experience. Maybe I couldn't glean as much from my education, but I have not been helped even one iota by my background as MBA graduate.
Correct.
Because in MBA, for example, you learn stuff like discounted cash flow analysis,
Hmm.
etc., in order to get to the intrinsic value of a company. But if you look at the market, even the fundamental research analysts, when they come out with a price target, they do it purely on the basis of multiples. And to me,
Yeah.
that really makes sense. You look at the
Yeah.
multiples, you look at the return ratios, and you can get a fairly good idea of what the stock should be valued at. This was never even taught to us in the MBA class when we
Yeah.
were students.
Correct. Great, that's true. That is true. So your journey, as I heard, is you traded in Hong Kong and then you came back to India, and since then you have also talked about the fact that you initially traded agri commodities, etc. And you have been a trend follower in general,
Yes,
and that is the principle that you actually follow. So
yes.
do you see when you look back your trading having evolved? One is evolving as a person itself. Second is, has your trading got changed a bit in style, etc.? Have you changed your term, long term, short term, medium term, etc.? Has it happened, or is it been just one kind of thing that you've been doing for a
No,
long time?
absolutely. There are two lessons that I have learned. Some of these lessons pretty recently, actually. So in 2008, when we were all very, I would say, novices in terms of trading, and we were still in Hong Kong. So me and a couple of my, let's say, peers in other banks, we were rejoicing at how much money we had made in 2008 because of the crash. Because
You could short.
fortunately,
Uh,
fortunately, we were on the short side, and also the derivatives position that we were carrying as a part of the bank's prop book strategy also made money because the markets went down. Now, there was this very senior person in Goldman Sachs. So, one of my peers was a Goldman Sachs guy, very good friend called Girish Mitran. I have lost touch with him, but anyway, so he had a very senior guy. And that senior guy told us, gave a kind of a warning to Girish, which Girish later conveyed to us, is that you're making money in short positions, well and good, but the super long-term trend in equities is up. Don't fight it.
Correct. Don't fight it for
And
too long. Yeah.
exactly. So that is the lesson that I really, really didn't realize, I would say, until 2017. I would say. It took me, even though I got that lesson in 2008, it took me like 10 years to internalize the lesson. Before that, I was more enamored by one of the Dalal Street sayings, which now I find perfectly erroneous, is that more money can be made in bear markets than in bull markets. That is an absolutely wrong statement. All
Correct.
you can say is that you can make money quicker in bear markets than in bull markets, but it is far harder to actually hold on to that money that you have made in bear markets. And I'll give you an example. In 2009, just before the elections, I was short. I was short. I even remember the stock. It was SR Oil,
Okay.
right? Just before the elections. And Obviously, the elections happened and I got stopped out very violently. And I even remember that I lost 400,000 US dollars on that one stock. But my boss didn't say anything because my boss was convinced that it's a bear market rally. This was in May 2009, as you can
Correct,
imagine.
correct.
So my boss was pretty convinced, as I was, that it's a completely bear market rally. And what was very interesting is that up until that point, even George Soros was pretty much convinced that it's a bear market rally.
True.
So my boss said that if George Soros is saying it's a bear market rally, you have done the right thing. You've got it wrong on timing. So he let
Yeah.
me off very easily, even though it was
Hmm.
a fairly good amount of loss.
Sizable loss, yeah.
So it taught me two things.
Hmm.
One, it gave me even greater confidence in the importance of trend following. Because had I been a pure trend follower in 2008 and 2009, then I would have probably been long and long quite a lot by
Correct.
the first 2 weeks of April.
Yeah.
That is
Be,
one.
definitely before the election, you would have been long. Yes.
Absolutely. So that's one. So even George Soros had he been trend follower. So anyway, that's a different story.
Correct.
Secondly, it goes and after that event, the fact that the market went up and up and up, and if you look at the US market, they have kind of tripled and even quadrupled, nearly quadrupled in case of the Nasdaq.
Correct.
It brings home the point that to have a bearish mindset for too long
Hmm.
can actually bankrupt you. It can bankrupt the best of traders. It can fool the best macro investor in the entire world.
Correct.
Because as the Goldman Sachs guy said, in the
Hmm.
long term, super long term, the equity market goes up. So that is one biggest lesson that I have now enshrined in my own strategy, whereby I am. So if you look at any technical analysis book or any trend following systems, you would see that they give an emphasis on being very sensitive when you're going short. So use a short-term moving average to go short
Yeah.
and use a more long-term moving average to go long.
Hmm.
My experience tell me you should do the opposite.
Yeah. You
You should
shouldn't.
find excuses to go long, even when you're trading a system, and you should find excuses not to go short when you're trading a system. But this applies only and only to equities. It does not apply to commodities or currencies, etc., where there is no bias. As I said, there is no
Correct.
trend, except for emerging market currency, where the trend is always to be on the depreciating side.
Correct.
But it's not easy to play the trend in depreciating emerging market currencies because of the carry. So if we go short a currency, an emerging market currency, you will lose
Hmm.
the interest rate that the currency will,
Yeah.
that you'll have to give up. So, but in stocks, my basic learning is find reasons to go long, even when you are trading a system.
So what I hear from you is that since commodities and currencies are probably unbiased in terms of they don't have this long bias at all. So you could probably have a system which is symmetrical when you're
Correct.
trading commodities and currencies. Symmetrical
Correct.
as in which will be equally long, which will find same reasons to be long or short. So there is no particular bias in that system. But in
Correct.
equities, you want a system which would typically be long biased. I mean, it will
Correct.
short, but it will be far more long biased than it's not a
Absolutely.
symmetrical long or short system.
Absolutely. I mean, you don't have to be ultra long when you want to go short. Even the 100-day moving average is good enough.
Yeah,
Sure, it will give you whipsaws once in a while, but that's fine. But on the long side, a 50-day moving average is, if the stock moves above the 50-day moving average, you should seriously rethink your short position, if not cover it.
okay. So you prefer a long bias system to a symmetrical kind of system when you're
Correct.
trading this. So let me, when since you're talking about systems, let me ask this basic question first. I mean, do you have a discretionary model, or are you a pure systematic trader, or you are a systematic trader with a discretion built on top,
No.
or things like that?
So the entire discretion
Yeah.
that I do is in choosing the stocks that I want to trade with the system. So I spend a lot of time reading equity research reports and trying to figure out, through people, say small and medium-sized businessmen who I keep meeting in my life. What's the stock that I should focus on in putting it into my systematic trading. For example, just this particular Sunday, I met the Asian Paints vendor who, because we are doing some maintenance work for the building, and I was always confused between the three stocks. You know, which of these three stocks I should put in my system, because the thing is that I want to trade only 10 stocks using my trend following system. So yeah, I
Correct.
can't put everything into it.
Correct.
So I'm always confused between, say, Asian Paints, Berger, and Pidilite. So until very recently, I had Berger inside because my reasoning was that the paint industry is going to do very well, and Berger being smaller than Asian Paints,
Yeah. We'll get the
statistically it should do better than Asian Paints in terms of revenue growth and all that. But
correct.
after meeting up with the Asian Paints vendor and figuring out that basically Asian Paints is not only a paints company now, but it's now uh, built an entire Pidilite inside it. So it is now gotten into the same business as Pidilite. So what I did is I chucked out Berger Paints
Okay.
and I have put Asian Paints into my system. Or into my so I will no longer trade Berger Paints. So Berger Paints is out and Asian Paints is in. So
Comes
this is
into yeah.
this is the discussion that I do keep doing on a daily basis.
Okay.
But inside the trading module, there is no discussion.
So the discretion is to the extent of which stocks to pick into
Correct.
your system, and then you trade the system on those stocks, right? So
Correct.
that is very clear. So there's no discretion in the system itself. It is a
No.
systematic trading system. Uh, so have you always been systematic, or you started off with a discretionary approach, or
So
how was it?
basically, what happened is that after my job as an equity research analyst in ISEC, within ISEC itself, during the last few months I was in ISEC, I basically got shifted to the futures trading desk.
Oh,
So
wow.
the fact that I went to Hong Kong is pure luck, actually. It's not even anything to do with my education, in a way. So I got shifted to the derivatives, the futures trading desk, where I met Anil Desai, who is a common friend.
Yeah.
So, and then immediately I joined an organization which used to be called REFCO, which was the
Oh,
world's
okay. Yeah.
largest
Clearing.
retail
Yeah.
futures and clearing broker up until 2010 or 2008. Everything was technical. So whether it is even the sales guys or the dealers, they were very, very technical and very, very short-term technical. So a lot of the time inside Repo used to spend going to Bloomberg and taking the technical analysis courses that Bloomberg University used
Would
to
give free. Yeah.
give for free. So initially it was technicals and trying to predict and all that until eventually I came across this book. Had I not come across this book of trend following, I would still have been a technical trader who would be trying to predict the markets using technicals. But once I read that book, uh, even before that, I had a kind of a gut feel, and I still remember why. I mean, this was in 2003, so I had shifted from REFCO to DSP Merrill Lynch, and then we had the massive bull run of 2003, if you remember.
Yeah.
And one day, after markets, I still remember all these instances very vividly because
Yeah.
they have made me in my journey as a trader. I was looking at the chart of Gujarat Abuja, and I had overlaid a 50-day moving average on it. And I saw that if I had just bought it, the stock went above 50-day moving average, I would still be long and I would have made 2x or 3x the money. So that was the first hint I got that, ride the trend.
Okay. Yeah.
Not until the book that I realized what the trend means and how profitable it could be. So
Correct.
that is how eventually stumbled into trend following formally. But I was getting again. It's in those roaring bull markets that you realize how important trends are.
Correct. That's why you can make your big money. Yeah.
Correct.
So, is there anything, which is a question I would like to ask anybody whom I meet now, is that if you could go back to those days, I mean, today with all the experience that you have, if you could go back to your younger self and give out something, I mean, say something that would actually help you in your trading, what would that be? What would that one thing be? If is there something like that that you would like
Right. So, firstly, again, the thing would be that don't try to act smart and be short.
to?
Because when you work in a bank in Hong Kong and you are constantly surrounded by hedge fund clients whose
Yeah,
entire motto is actually to outperform the market when the market is not performing very well. So your intrinsic mindset becomes that smart people are the ones who know how to make money by going short.
correct.
Okay, and that's the wrong mindset to have if you're trading equity. Uh, uh, sure, once in a while you can catch a DHFL or a Yes Bank and ride all the way down to the bottom, but those are very, very stock specific instances which will be few and far between. So the first thing I would tell my younger self is A, you have to be long biased, and B, uh, see, when I was younger, because I started out as an IT analyst, I always used to kind of look down upon, and this is the right word, look down upon FMCG stocks. I found them boring. I mean, why are people even
Investing in
into
them,
that
yeah.
thing? And eventually, as we have realized over the last, yeah. So I would say in IT, you buy a stock and it goes up like 100% in 3 months. That's the space to be in. So even though IT has generated a lot of wealth for long-term investors, so because of my initial job, I never really looked at the how much money consumer stocks can make. And immediately after that, we had this entire bull run in between 2003 and 2007. If you realize, that favored the cyclical sectors. So you had
Correct.
construction, you had metals, commodities, everything. So my
Infrastructure,
entire
yeah.
mindset was wrong up until the very recently. So even in 2012, the stocks that I chose for my trend following system were stuff like TLF, Tata Steel, Tata Motors, JSW Steel.
Hmm.
I never chose a stock like Asian Paints.
Correct.
Uh,
Or a
I chose
Hindustan Lever.
no,
Huh.
no, no. At best, I chose banks like SBI and
Yeah.
all that. So and eventually, so the one thing I would tell my younger self is choose high quality growth stocks and trade those stocks with a trend following system, and that's the way to make money. So be long biased, choose high quality growth stocks. Don't get biased towards any particular sector. One very very important lesson, key lesson: the older I grow, the more focused I would be on the return on equity of a particular stock rather than EPS growth. Because I have found that stocks with high return on equity also tend to produce more smoother trends.
Correct.
So that is something that is I find very interesting, even though I have not tested it universally, whether this is true or not, it's just an observation. So that is what I would tell myself.
Fantastic. Yeah, that is clear now. You did mention it earlier also, so this is pretty clear. You said that you would want to be long biased, and clearly that's the lesson that you would want to give to your own self, if you could in the past. I think that would have changed a lot of things for you in those
Yeah,
days, right?
absolutely.
So then there is this. Then there is this thing about you don't trade indices at all, or is it
I do.
just you do?
No, so I trade 10 stocks and two indices, Nifty and Bank Nifty. Uh, so here is the difference that I have. So my stocks, when I uh, want to go short, it is far longer than the 100-day moving average.
Okay.
But in the indices, I use the 100-day moving average to go short because I am not using indices to make money, long-term money. Rather, I'm using the indices to go short
Hmm. Hmm.
as a hedge on my portfolio, which
Which
I
could be
don't.
long.
So
Yeah.
basically, I don't want to lose my portfolio uh, so very easily.
Okay.
So in the portfolio, the average that I use to go short is far longer than the 100-day moving average.
Yes. So
But it does make so if you do, but the problem is if you do that, you will have very high, peak to trough drawdowns. It
drawdowns.
could
Yes.
be as high as 40% for somebody who is leveraged. Okay,
Yes.
to control that, I need to have hedges which is nothing but the Nifty and the Bank Nifty, where I am more prepared to go short. So
Sure.
those are the two asset classes where I am more inclined to say that, okay, I don't want to make money on the long side, but I want to make a lot of money on the short side.
So
So
that
yes,
actually protects you from losing money
from
or
those
the drawdowns.
brutal 40%. No, see, if I go and tell any investor, so let's say tomorrow, even though I don't intend to, if I go and tell an investor that, look, I have a system that is going to make 50% return pre-tax over the long term, but yes, it will have a 50% drawdown as well. Okay, because it's going to be leveraged. So nobody's going to buy that. Okay,
Correct.
even though I believe that it's a good system to have if you are interested in long-term wealth creation. So
Okay.
I kind of don't buy into this entire hedge fund, uh, you know, uh, absolute return, market neutral kind of a asset class. If your goal is wealth creation, if
Correct.
your goal is wealth creation, you have to take risks and you have to weather those drawdowns. But in order to reduce those drawdowns by a bit, yeah, you can hedge using the Nifty futures. So the maximum drawdown that I've had so far is in the mid 20s, which
Okay.
for me is a comfortable drawdown. So because my long-term intention is to have a 50% pre-tax return with a 25%, or I'm even willing to have a drawdown as high as 30%. Because for me, given my stage lifestyle, for me, I need wealth creation through massive returns over a long-term period.
Okay. So the stocks position that you take are actually in stocks in the cash market, or are they in the futures
No,
market?
no, futures,
Futures.
because that's the only way in which you can get leverage.
Correct. So then when you say the drawdowns, you're talking about drawdowns on margin or drawdowns on the exposure that you have taken?
Exposure,
Exposure that you've taken. So there you understand the amount of leverage that you've taken, and
correct,
it fits into your risk profile that you're
correct,
willing to have, right? So
correct.
clearly, because
So
leverage is
that correct. So one of the ways in which you can manage your drawdowns also, or make it slightly more comfortable, is that when you first get the buy signal, so you put, let's say, 1% or 2% of your equity uh, into that particular stock. Eventually, my aim is to put 5% of equity in those in each individual stock, because I'm only trading 10 stocks, but I don't do that all at once. So I initially start with 1%, and then
okay.
one moving as and when the moving averages are getting taken out. So I have initially, let's say I start with the 50-day moving average, I put 1% of my equity, then at 100-day I put 2% of my equity, and so on until I'm completely invested at a particular moving average. I'm long 5% of my equity in a particular stock. What that does is that by the time I'm fully invested, I have a sizable amount of profit that I can afford to lose.
Great.
So it's a cushion of on my principal. So
Okay.
I don't know whether what I'm going to say is intelligent or stupid. It is far easier to lose the cushion of your profits than once the drawdown starts eating into my principal. What I do actually is I cover everything. I
Okay.
get out of it. I get out of everything because in my principal, as I said, I have a maximum drawdown of 25%. In my principal, I have never had a drawdown of more than 6%. Because the moment my principal starts getting eroded to the point of 6%, I completely cover everything and I start very, very small with just like even 25 basis points of my equity in just
Okay.
2 or 3 stocks. And
Yeah.
then I rebuild the position.
Rebuild it. Okay.
Correct.
Correct. Correct. So clearly, you have a own risk management principle built into your trading process.
Correct.
Right? It is not something that you
Correct.
you follow it to the T. So, and this
And
is something that you have evolved with. This has evolved or
absolutely,
it
absolutely.
developed.
It's evolved because of fear, because I don't have a job, so I can't fall back on a salary. This is my business. So
Yeah.
in my business, I have to protect my principal even if I'm not making returns, even if that means that I have to start over again and again and again, which I did after the Brexit actually, which I did after I realized that commodities don't trend. So I have restarted twice actually over
Okay.
a period of let's say 8 or 9 years, ever since I've become an independent trader. So protecting the principal is very, very essential
Correct.
because what has been very, very good to me because of pure luck is the Nifty Beast position.
Yes.
Because all my margin, so what I've done is I have my principal and I realize that I don't need more than 40% of my principal in cash to
Correct.
manage the mark to market. I don't even need that much. So I put
Yes.
60% of my principal in Nifty Bs. And that I did in the, the depths of the 2013 bear market, or, when the market collapsed. So that position has, as you would imagine.
That has actually helped you, yes.
So
Yeah.
now when I look at it, I'm pretty relaxed, even if I don't make money on my trading. I do make money on my trading, but that's been very helpful and it's been completely accidental. I just had this thought one day, why am I putting cash? Why don't I put Nifty Bs? Because I don't need all of my money for mark to market.
Yeah. But that actually could have easily been, the thought could easily have been, why not put it into liquid Bs, and the story would have been very different.
Very different. Yes. Yeah.
Yeah. No, so obviously, I think it is time to ask you this important question as to what is the advice that you would want to give any would-be trader? So I will not say young, or it's a new trader, somebody entering the market, something that could help him fasten his learning curve. What would that kind of advice be?
So basically, read two books. One is How to Make Money in Stocks by William O'Neill.
Yes.
So that's the book that is going to help you with the stock selection. So, and apply that book, the concepts of that book every day to refine your stock selection. It's not necessary that once you have chosen those 10 or 20 stocks, you need to stick with them. So that's one. And then obviously you read another very thin book. I think it's Technical Analysis Explained by Jack Schwager. So it has got two parts. The first part is the normal technical analysis, chart patterns, moving averages, oscillators. And the second part is about how to build systems.
Okay, excellent.
And you read these two books, combine the knowledge of these two books, and then it is up to you whether you want to be a fundamental investor or whether you want to be a trend follower, or whether you simply want to be a technical investor who wants to predict the markets. That's also fine. Chart patterns do work, not as if they don't work. And if you do decide to become a fundamental investor, please, the only advice I would give you is have a technical stop on your fundamental positions. Because even the best of the traders have held on to positions for far too long. In fact, this is what I have realized. This is one of the biggest learnings also. If you're a professional trader, taking a stop loss is not very difficult.
Correct.
And if you can't take a stop loss, then you're not a professional trader anyway.
Yeah, that is part of our life. Yeah.
What is very difficult, and I think even George Soros is learning to this day, this moment, is how to take your profits. So the first thing I would actually go back and tell my younger self also is let your profits run. I'm not worried about stop losses if you're a professional trader, but as I said, let your profits run. Have an excuse not to get out of your position too early. So I would give the same advice to a fundamental trader that have technical reasons to get out of a stock. So let's say if DLF. So we all know that what is a trend. When a trend is when a market makes high and higher lows.
Yeah.
So my simple advice is study the monthly chart. If the monthly low, immediate monthly low has been broken, for once at least get out of your position and reevaluate it. And if you have to re-enter the position, re-enter it after a full evaluation. If you do that, then you will not have accidents in stocks like say DHFL, Yes Bank, or even an Emami for that matter, which I know a lot of my friends have bought into very recently, in the 2017 mid-cap mania, if you could call it. So if you have a simple, even if you're a fundamental investor, have a simple technical rule to get out of your position, because whether you're a fundamental investor, whether you're a trend follower, whether you're a technical trader, price always moves ahead of money.
True, very true. I think I have to say that this has been a very enlightening interview. You have had a terrific experience for so long, and I'm very glad that you actually agreed to come here and talk about it, because it is very, very important, I think, and I'm sure you would agree that if at the time you started, you could listen to somebody else speak.
Absolutely.
And I think at that time, none of us really had any kind of mentor or somebody whom we could
Absolutely.
look up to and say that, okay, this is how. So we had to read and learn over a period of time.
Absolutely.
And I think this is something that is extremely useful, because here is a trader who has done it all and is saying that this is how I have evolved and this is what I do. I'm sure there will be other ways of doing things, but at least this gives a in general principle of what is something that a person should look out for, a new trader should look out for. And I'm really grateful that you actually came here and shared all your ideas and your experience with us. And I hope that we will probably in the future have more reasons to talk and about other things. And I would call you again when that comes up. But at this moment, I have to just say thank you once again.
Thank you. Thank you.
And we will keep in touch. Thanks. Bye.
Bye.